So welcome. This webinar is, well, what you see is what you get, getting ready for the Fed, Bank of England, and non-farm payrolls, one event after the other. It's a busy kickoff to November. A quick presentation of myself. I used to be a retail trader and a computer programmer. I founded Forex Crunch, my website, back in 2008, all about Forex. Joined FX Street 10 years afterwards, 2018. And my focus is on fundamental analysis. That's what we'll be talking today, leading FX Street's premium content offering. And yeah, and quickly before we begin, let's talk about this premium offering. A bit of a pitch, a bit of promotion. It'll be quick. So we have an offer today for quite a nice discount. I'll share the link right here in the chat. Anyway, what you get in premium is you can tap into 20 years of our experience, Thomas Sayes, Ivan Cummings, and myself. You have access to instant trade notifications. We talk about all kinds of markets, not only Forex, not only about stocks, not only about crypto, and you can ask us questions directly. This is a quick look at our premium, in the Forex Discord community. We accompany you during your trading day, provide daily trading alerts, signals, analysis, strategies, economic data. You can leverage your actionable content, and we've been getting positive feedback. You can see a bit of them here. What I need to know when I need to know it, excellent insights, and also great inspiration. That's what people are saying. And yeah, you have lots of experience to tap into and lots of actionable content. You get to follow our trade plans and learn by doing. And yeah, and I think our community has a really nice atmosphere in it, which is also, well, I enjoy it a lot. I think those do inside. So that's our promotion. First month for only $9.99. Just for today. It's a quick offer. It's not even Black Friday, and we're already moving forward. So if you want, use the link that I've shared here in the chat and go ahead and sign up if you're still not in a premium member. Okay, let's get to the chase. My table of contents is quite straightforward. Nothing too much. Nothing you haven't thought about. Fed, Bank of England, non-farm payrolls, and then questions and answers as much as needed. The longer part will be the Fed. Today's event, it's the most important one. So let's kick it off. What's priced in? Let's get rid of the obvious, or what for me is obvious, but maybe for not all of you it's obvious. We're going to have a 75 basis point rate hike from a range of 3 to 3.25 to 3.75 to 4%. That is fully priced in. Markets are not focusing on the rate hike. So we can have the dollar falling despite a rate hike from the Fed because that is already priced in. In the extreme case, we get something else. 100 BPS rate hike, that'll be dollar positive for sure. Stocks negative. If we get 50 BPS, it's dollar negative, stocks positive. But really, I'm just saying it because I never say never. But yeah, it's a 75 basis point, and let's assume that. And the reaction depends on what's next. And what's next is December. That's the next meeting. That's the main focus of markets. So markets are looking one step forward, but not too far into the future. They do care about the peak interest rate, what's going to happen in 2023. But this is a screenshot I took yesterday, but it hasn't changed much. These are expectations for December. So it's basically split half and half between a 50 point BPS rate hike and 75. Markets want to see what we call a pivot. Pivot doesn't mean cutting interest rates right now, but when I say pivot, we're talking about slowing down the pace of rate hikes. This is going to be most probably the fourth consecutive 75 BPS rate hike, and pivot would be slowing down. We'll be saying, okay, we already did enough. We're not stopping. We're not cutting rates, but we're slowing things down. That is only half priced in, more or less 50-50 according to bond markets. The long term, that depends on what happens with inflation. We have the dot plot, the Fed's own forecasts from back in September. They pointed to a peak rate of 4.6. That means a range of 4.5 to 4.75. That was in September. Since then, we had strong data, especially strong CPI. That's the main driver, consumer price index. The biggest driver. Every small figure moves markets. It topped 5% at some point. because of this, because of very high inflation. Core inflation reached 6.6%. The Fed cares about core inflation, which it can impact much more than it cares about headline inflation. Sure, Americans drive cars and eat food like everybody else, but the Fed has less impact on these prices, which are more volatile and depend on global markets and the war in Ukraine and Chinese demand and you name it. And core inflation is more a result of supply and demand, which the Fed has more impact via interest rates. So, Rocky, the eye of the tiger, that was the number one hit last time core inflation reached 6.6%. So we had this rise in expectations, and then came this guy. That's from his Twitter feed. He doesn't really look exactly like that. Nick Timiraos. Hope I'm not butchering his name. Anyway, he's the Fed watcher for the Wall Street Journal, a very reputable newspaper, and he got his reputation as the Fed whisperer, the Fed leaker, the Fed insider. So we had him coming out on October 21st, just before the Fed came into this. It's a blackout period, and he hinted that the Fed would slow down in December. Very subtle hints, but it seemed like he got some information, because back in June, he conveyed the message to markets that the Fed would move from 50 to 75. So markets are following every article he publishes. Yeah, so it fell under 5%. I missed that 5% word here. But then Timiraos came out once again over the weekend on October 30th, just on Sunday, and he talked about the Fed seeing higher rates. Why? Because people have more money in their pockets, 1.7 trillion, and corporates have lower debt. And yeah, so markets moved again to price the peak rate a bit higher. So it's quite a mess what's going on in markets. But let's forget about what this guy says. Let's look at the data. And this is the good data. Let's start with the good news. Labor market looks really strong. So this is the total employment in the US. It crashed around the pandemic, and now it's above pre-pandemic levels. The last non-farm payrolls was 263,000, above the pre-pandemic average of just around 200,000, and jobless claims, sort of a leading indicator, they remain low also in October. Okay, GDP grew a bit more than expected. Economy looks strong, no recession. Those 2 quarters of contraction seemed like an issue with the data. The economy still looks strong. The bad data is that the housing sector is suffering. This is not 2008, but house prices are falling from this pandemic jump, and there are fewer transactions. It seems like higher interest rates mean higher mortgage rates mean, of course, I mean, the Fed's policy is working. And if the Fed's policy is working, so why not stop? Why not pivot? Why not lower expectations? There's another reason to maybe pivot, is that monetary policy works with the lag. The Fed raises interest rates now. The impact of this hike will be felt only in a few months. People make decisions not that quickly, not on houses, and also companies, they want to be convinced that inflation is falling. They want to be convinced. It takes time. So maybe the Fed needs to act now to get ahead of the curve. They missed the big rise in inflation back this time last year. They didn't expect to raise rates at all in 2022, and were already with rates touching 4% now. So maybe they should do a dovish twist. Maybe we'll see Powell letting the dove free, letting, like Elon Musk, setting the bird free. But there are other complications. There are new forecasts coming out in December. So maybe the Fed would make such a bigger decision of slowing rate hikes only in December, only when it has its new dot plot. And more importantly, I chose this annoying GIF here, sorry, is that we'll have until December 2 more non-farm payrolls reports. We'll talk about one of them right now, and 2 more CPI reports, which are more important. So I'll leave you with 2 dates to remember. That's November 10th and December 13th. The biggest market mover is CPI, but also non-farm payrolls matter because the Fed has 2 mandates, full employment and price stability. And these are the most important data points. But yeah, every small data point moves markets. So why should they pre-announce anything, right? Why should the Fed commit now, if it says it's data dependent, if it says it just makes decisions meeting by meeting, why should it guide markets that much? Well, sure, this Nick Tomorrow's guy will guide markets, and they can also respond to the data. So what does uncertainty mean? Well, before we talk about uncertainty, let's talk about talked about the good, the bad, and the ugly. So there are three ugly things. Monetary policy works with the lag, so we don't know how much impact we'll have from this Fed decision. The second thing is we'll have lots of data until the next decision. And the third thing is elections, and the Fed cannot ignore politics. Okay, inflation is the top thing worrying voters. Yeah, this is one of those, well, Republican things, blaming Biden for inflation. He has part of the blame. Global things have part of the blame. We won't get into politics. It doesn't really impact how the dollar will move. But we have to know, what we need to know is that there are elections, midterm elections, in 6 days from now. So the Fed cannot be seen as being loose on inflation or committing to such a pivot. So what to expect? Yeah, I'm sure we'll get a commitment to fight high inflation. Again, recent inflation figures were very strong. Second thing is that we'll get what I said, these cliches, but let's not call them cliches. Sorry, the Fed is really data dependent, and markets are taking it seriously. Every data point moves markets, and that they'll decide meeting by minute. They'll decide according to data. Markets don't like uncertainty. Okay. I mean, we humans don't like uncertainty. We want to be sure of something. Some people well, prefer bad news over not knowing something. And so I think that a message that we're not committing to anything would not be that great for markets. But on the other hand, markets are clamoring. They really want this pivot message. They want this message that the worst is over, that the Fed is beginning to slow down its path of rate hikes, then stop raising rates, then lowering rates to give the economy more of a boost, to give stocks more of a boost, especially tech stocks, which are extremely sensitive to higher rates. So I believe that markets will look for a pivot, will look for any kind of hint that, especially from Fed Chair Jerome Powell, that that the central bank is ready to consider maybe slowing down the path of rate hikes. I don't think we'll get any kind of commitment, but I think they'll just cling on to some kind of a hint, and we could have the dollar fall initially, stocks rising initially, until the dust will settle, until we'll get some kind of a hangover. And another reason I'm saying that is that in the recent past, most reactions were like this. We got some, okay, Powell is not that hawkish. Okay, not as hawkish, I mean, it could have been worse kind of reaction. So markets rise, and only later they get the hangover on Thursday, or when Tokyo opens, or when Europe joins in. So that's my bet for now, that the dollar will first fall, and then will return to its position as king. And another thing I added to this presentation in the very last moment is some tweet I've seen, and I think it's irrelevant. The length of the speech matters. Back in Jackson Hole, Powell was very hawkish. He spoke for exactly 8 minutes, and well, I'm already double that in this webinar. Okay, he spoke for only 8 minutes, sent a very clear message, very hawkish. Markets reacted. Stocks fell, the dollar jumped. If he talks more and more, markets might find in his words, in his sort of honest approach, I would say, or straightforward, or just saying we don't know, we could do anything next time. They might find that that dovish hint that they're so looking for. So if he ends the press conference short, or he refuses to, or he's very tough on inflation, especially the length of the speech, that will be more hawkish. And if he goes on, and let's say reporters catch him by the tongue, as we say, then I think we could have a more of a dovish reaction to the initial, to the Fed. I think the following day will be already be dollar up, stocks down kind of thing. Okay, yeah. Before I move to the Bank of England, I see quite a few questions here, so I'll take them. Yeah, we have a question from Howard Jackson. Why do you use this piece of Okay. Well, it's a comment about the presentation. If you have another tool for making presentations, please let me know. Another comment is about the full schedule. So the Fed makes its decision in just under 2 hours at 6 p.m. GMT. Okay, that'll be 2 Eastern time. That'll be 7 p.m. here in Barcelona. For those of you on premium, we'll be beginning live coverage, live commentary, means reacting more actively, commenting more actively, and of course answering your questions half an hour before the event at 5:30 GMT. That means in just over an hour. And yeah, the press conference by Jerome Powell is at 6:30 GMT, 2:30 Eastern. That's today's schedule. I'll mention tomorrow, the rest of the schedule when we talk about that. Another question here, is inflation more important now than employment or central banks? Yes, the answer, well, inflation, CPI is more important than non-farm payrolls. Non-farm payrolls used to be the king of Forex indicators, not anymore. It's inflation. The Fed in theory has two mandates, but since employment looks good and it focuses on inflation is political, it's all about inflation. CPI moves markets more than non-farm payrolls. But the Fed still moves markets, not by the decision itself, which it telegraphs, which it conveys weeks in advance, it's going to be 75, but by what Powell says. But what will Powell say? We're data dependent. We take decisions meeting by meeting. So yeah, I think I haven't checked it, but the last 3 CPI decisions had more of a market impact. We had 2 strong ones and 1 negative one in August, for July, and they had more of a market impact than the Fed decision, and they had a longer lasting impact. I would say still what the Fed says is important, very important. Jackson Hole is an example of a non-Fed decision comment by Powell that moved markets, and other speakers also have impact. Yeah, I hope that answers your question. Okay, no more questions about that. Let's move to, we have another question here in the Q&A, which is a separate chat here in this webinar. Could it be a question from Alex? Could it be that comes out with 50 basis points instead of 75? This would be certainly rally markets and everyone will be making a lot of money. Yeah. And if he does 75, likely that markets dump. Yeah, well, again, if we have a 50 basis point rate hike, it'll be a shock. It'll be sending a message that the Fed knows something really bad that we don't know. I don't expect it to happen. They would have told us already. But yeah, it'll send the markets higher. Maybe could cause panic because there's something scary. I don't see that happening. I also don't see a 100 basis point happening. 100 basis point could also have the opposite effect of initially sending markets down, but then up on, okay, maybe it's the last rate hike. It's very unlikely. Let's say it's a 99.9% chance of a 75 basis point rate hike, and then what's left there, 0.1% divided by these two extreme options. So I don't see that happening. I see 75 basis point, and then the reaction depending on what Powell says, what the statement says. There are a few smaller details, like if there are dissenters, but basically it's about what Powell says about the future. Okay, so you can continue asking questions about the Fed, but I'll move on in the meantime to the other 2 events. Bank of England. So I'll start with the schedule. It happens at 12 p.m. GMT, which is what is the time there in Eastern time? That'll be 8 Eastern time, a half an hour before Wall Street opens. Okay, and it's a Super Thursday event. It means there is not only the rate decision and the meeting minutes, but also the MPR, the Monetary Policy Report, which happens only every other meeting. It's a quarterly event, and it includes forecasts and the press conference at 12:30 GMT, 8:30 Eastern, just when Wall Street opens, from Governor Andrew Bailey and a few of his colleagues. So that's the schedule, just to do some, to clear that. At the last time I looked, markets still expect a 75 basis point rate hike to fight double-digit inflation, around 10% in the UK. Things have calmed down a bit since that anarchy in the UK event that we had in the past month and a half. So, small reminder. Another reason. Well, a small reminder about what happened in the UK. We had Boris Johnson with his scandals being ousted. Then a long campaign. Liz Truss was elected Prime Minister, promising the Conservative Party members to cut taxes, promising everybody to support them with energy bills. And then, she had a few days of calm in office when the Queen died, and there was no politics. And then she and her Chancellor presented the mini budget. It was a maximum damage event for the UK economy. So we had an outflow of funds out of the UK. Bonds were sold off, yields shot higher. She was forced to backtrack on most events, and eventually she was ousted. And we have a new Prime Minister, the third in 2 months, Rishi Sunak, formerly the Chancellor. Looks like a safer pair of hands, at least more competent. For now, the party is still divided. Anyway, British politics is fascinating, but what we need to know is that one reason to expect 75 basis points is that markets are still pricing a higher path of interest rates because of all this debacle, and that other banks such as ECB and the Fed today, they'll go for 70, almost surely for 75. So the the Bank of England needs to keep up. On the other hand, why go small? Well, there is here Liz Truss and Rishi Sunak. Politics have calmed significantly. It's no longer, we're going to have a bit of, bond yields in the UK have gone down. We have a bit more of political stability. And the budget from Rishi Sunak and his Chancellor Jeremy Hunt, it's due out only on November 17th. That's in 2 weeks. So why raise rates now before you know what's going on? Maybe save some dry powder. And the pound doesn't need any more shoring. So in the worst of the crisis, this mini budget, pound dollar fell to 103.50. Now it's at around 115, hovering around that level. And euro pound is also more stable. So if we look from a foreign exchange perspective, the pound doesn't need help at this point. Okay, so there are other reasons to go small. A triple dose move of 75 basis points would be a precedent. So far, the Bank of England raised rates by only 50 basis points for a long time, at least in this cycle. And the committee is quite divided between hawks and doves. Last time we had something like 5 members, including the governor, voting for a 50 basis point rate hike, but 3 voting for 75 and 1 voting for 25. So that's a mess. So why would they take an extreme decision when they're so divided? And of course, a recession is looming. The last GDP figure was quite disappointing, and I think that the UK already might be in a recession, so they wouldn't want to raise rates very aggressively into a recession. Okay, and but just things to take into account. Super Thursday, we have the rate decision, and we have the meeting minutes, and then we have Super Thursday. So the meeting minutes show how the 9 members of the Monetary Policy Committee, MPC, how they voted. If we have a 75 basis point rate hike, but 4 voted against it, 4 out of 9 and 5 for it, that's relatively dovish. And if we have a 50 basis point rate hike, but with 4 voting for 75, that would be relatively hawkish. I think we'll have a 50 basis point rate hike, which would be dovish, and with something like 6 or 7 members voting for it, a stronger majority. And you might have a wild card from comments about QT. It's not QT, it's quantitative tightening. It's when the central bank sells bonds it bought in the past, which is, of course, bullish for the currency. I don't think they'll change their policy, but if they do, if they say we'll speed it up, unlikely. It'll be good for the pound. If they say they'll stop it because they're afraid of worse outcomes or something like that, it'll be the opposite. But I think the rate hike is more important. And what makes it really super is Super Thursday, is the monetary policy report. Last time on this Super Thursday, we had the Bank of England forecasting a 5-quarter recession. They said it would be shallow. They said it would begin only from this quarter, from the fourth quarter, but last all the way until the end of next year. That's what they said back in August. And they tend to be gloomy. This is Andrew Bailey, the governor, holding his head. That's his general approach. Depressed. His members are also quite boring and depressed, not like Powell, which is more sort of American style upbeat. And I think that they could now change their forecast to a deeper recession instead of a shallower one. Things have worsened because of this maxi budget crisis, and that could be bad for the pound. Another thing that makes it super is, I mentioned already, that Governor Andrew Bailey holds a press conference. He's honest, let's call it, very gloomy. We'll talk about things getting worse before they get better. In the past, for instance, he asked Brits not to ask for a wage rise because that would that would raise inflation. So he's not exactly Mr. Nice Guy. Well, he speaks very calmly, but yeah, I think he'll add fuel to the fire, I mean damage to the pound. Any questions about that? Yeah, I see a comment here saying wild card. Yeah, wild card. I mean, markets aren't focused on the quantitative tightening policy, more on the rate hike and the forecasts. So this, if the Bank of England makes any change to its plan to squeeze the balance sheet, if it decides to print more pounds to support the government, that would be bad for the pound. And if it decides to speed up the process of selling its bonds, that means taking pounds out of the market, that would be good. That would be good for the pound. So nobody's talking about that. I don't expect any change. There's a good reason nobody's talking about that. But if they do make any change, it was important when the crisis was rife. That was something like 3 weeks ago, and markets move fast, so that was a long time. And I don't think they'll make any change now. They'll want to keep some calm on that front as well. Okay, so that's the Bank of England. Any more questions on the BOE? Or I'll move to the last event of the week. Yeah, I'll move to the last event of the week, non-farm payrolls. So yeah, non-farm payrolls comes on Friday. I'll begin with the schedule. It's released at 12:30 GMT, which is 8:30 Eastern time. But here in Europe, we move the clocks. So if you're, that'll be 12:30 in London or 1:30 here in Europe. So that'll be a bit earlier because we have moved the clocks, but Americans haven't. There's just one data point, no press conference, and one number to focus on. Forget wages; it's only about the headline figure. A further slowdown in job growth is expected, 190,000. That's more or less the pre-pandemic average, and that's 2019. So that would be a return to normal, which is well, normal is good after this perma crisis, which is the word of the year, I think. Anyway, we'll be returning to pre-pandemic levels. That's a slowdown, but still job creation, still not pain, still not justifying a pivot from the Fed, not justifying a slowdown in the pace of Fed rate hike. Okay, for markets really need a negative jobs report, a loss of jobs, really bad news for Americans, for a full Fed pivot, for the Fed to say, oh, our policy is working too well, and we need to stop. And I don't think we'll get that. We got this ADP report today, which came out better than expected, and all the other indicators are showing strong employment growth. I don't think we'll get a bad number. Mentioned jobless claims. Last jobless claims figures we got were for the week ending October 21st. They were low, 220,000, around those pre-pandemic levels. Service sector is on fire, so if manufacturing is struggling because people are buying less stuff, they're flying a lot, they're going on vacation. Going to restaurant service sector is doing really well. So I think we'll have a good figure there. We'll have, I think there's a good reason to expect a positive surprise, and that could send the dollar higher. That'll be, I mean, we talked about data dependency. If we get more jobs than expected, or even as expected, the dollar could rise, stocks would fall. That'll be sort of completing the anti-pivot or the doubts about a pivot move in markets. So that's what I expect from non-farm payrolls. Yeah, but the reaction in non-farm payrolls also depends on the Fed. I'm assuming the Fed will not commit to a pivot, will not commit to slowing down the pace of rate hikes in December, and so that's why I expect even an okay number to be very good for the dollar and bad for stocks. But if the Fed does commit to a pivot, which I don't expect, but it can happen, then even a good number or just above average number would be sort of okay. The Fed is going to pivot anyway, and America is hiring. Good for stocks. I mean, good news is good news, but I don't think that'll happen. Not now. Yeah, so it needs to fit into the narrative, like everything, and a lot of the narrative depends on the central bank. Yeah, and we already, thanks to your comments, I already talked about inflation and how inflation is more important than jobs now. And yeah, so CPI is more important than NFP. That's next week. It's on November 7th. Sorry, November 10th. Anyway, that's a key event. We need to see core inflation falling. It's not part of my presentation today, but I suspect I've been saying it on the premium Discord channel that I expect I expect inflation to finally begin falling. Supply chain issues are getting easier. Gasoline prices are stable but not falling, but other things are calming down just a bit. And I think that core inflation pace of 6.6, or if you annualize last month's figure of 0.6, we even get to 7.2. I don't think it'll continue with all the tightening from the Fed and people talking about inflation and unwilling to pay every price possible. So I think that could be a game changer for markets. That could be a big dollar downer and a big stocks booster. But let's see the expectations for next week. We'll talk next week about that. We'll have previews all about that. So yeah, that's there's still time. I mean, we saw how markets reacted to yesterday's data, sending the dollar up. We got that positive jobs figure. We got ISM manufacturing PMI just 0.2 above expectations. It's nothing in this figure, but the dollar jumping, and then we got, I mean, last week housing figures worse than expected, and the dollar tumbled. So markets are really sensitive to data. So that's why I want to say believe the Fed when it says it's data dependent and makes decisions on a meeting by meeting basis. I think that's the end of what I've prepared for you today. I'll do my small pitch once again. You're ready to, if you're ready, join our premium offering. We have a special offer. Just well, it's like a free trial. Just $9.99, under $10. Yeah, I'm doing the marketing thing here. You can use the link I'll share here and sign up. So it's basically almost a free trial. For 1 month, you get to tap into our knowledge, get to see how it's going, see how it can help you with your trading, and yeah, it's an opportunity. I think we get lots of positive feedback, so yeah, so you can join that, and we have, I think, a bit more time to, if you have any questions. So yeah, if you sign up now, you can take advantage of premium already now, and for sure, non-farm payrolls, Bank of England. So that's your opportunity. Looking forward to more questions if you have them. Okay, I'll just take a look, see how the last minute positioning is in markets. I get the right screen here. Too many tabs. Are you suffering also from too many tabs? Yeah, so this is, well, oil prices are going up. We have these rumors about Chinese reopening, but let's look at euro dollar. Yeah, we've seen the dollar strengthen a bit today. We've seen the euro dollar slipping to the lows there, 98.59 at the moment. So higher dollar, pound is also falling, 114.50, and the yen is right around support. I should move that line right here. And yeah, so we've seen the dollar strengthening. For me, it's not a huge move. It's not accompanied by a crash in markets. For instance, oh well, since I last looked at the S&P, it's been falling a bit more. It's 0.8% down. For me, this kind of risk-off sentiment means markets are pricing in a more hawkish outcome, which I expect. I expect no commitment for a pivot. But that also raises the chances of the pendulum swinging the other way. We have one day up, one day down. So if we get some kind of a hint from Powell, even an unintentional one, that we might consider thinking about changing the pace of rate hikes in December, depending on the data, depending on other things, we could see a swing to the other direction, which means dollar down, stocks up. And for gold, gold has been dropping alongside stocks despite very stable US 10-year yields. So I think yields are reflecting just the long wait for the Fed. They're not sure what's going to happen, and it makes sense to stand. But other markets are a bit on the move. Stocks are down. The dollar is up across the board. Oil, I would exclude it. It's more related to hopes that rumors that China will reopen. Some screenshot running on Chinese social media, half denied by the government, is doing the rounds there. So yeah, that's what's going on. Yeah, I guess that's it. I don't see any more questions. Let me switch back to my presentation. Once again, you're welcome. Well, if you're on Premium, you're welcome also to look into our trading studio. Yeah, look into our Discord channel, and which is our community, very vibrant. You can follow me on Twitter at Yochai and well, fxfree.com for the calendar to see what happens. And yeah, I'll promote once again for those of you that haven't that aren't in Premium, you can take advantage of our special offer of just $9.99, as Americans say, for a full month, which is a huge discount, 75%. And see how it works for you. It's not a big sum for a full month of access. And then you can see you can all cancel anytime. So I don't see anything you risk over there. Okay, I've been talking quite a lot. If there aren't any last minute questions, I'll be closing this session. Yeah, I think we allocated 45 minutes and it's 42 are already gone. And for this individual who doesn't like the presentation, I'm really open to feedback. If you have another tool to do a nice presentation, different colors, yeah, just let me know. You can access me here. So yeah, that's it. So that's it for now. It's will be those of you in Premium will be beginning our coverage in 45 minutes. Time for me to refresh myself, and yeah, we'll have recording of this webinar, which will be useful, especially for the Bank of England and Nonfarm Payrolls. And yeah, hope to see you everybody soon, wherever you are. And so that's it for me for today. I hope you've learned something new. Always important to learn something. And yeah, I'll be with a new webinar in December. and maybe even earlier. Everything will be discussed and will be announced in due time. We'll be promoting and communicating everything. Communication is always important. Okay, so I've been talking quite a lot. Wish everybody to have successful trades in the Fed. It's going to be a messy, let me just finish. It's going to be a messy event. We're going to have lots of ups and downs in the markets. If you're not sure of what you're doing, trade, either stay out and watch the event, trade only with the demo account, or trade with a small amount. We're going to see really choppy action. So yeah, widen your stops. It's good, but keep your stops. Don't use mental stops, which can be mentally damaging, and trade with care. Yeah, we'll be accompanying you. Alrighty then. So that's it for now. Thank you very much, everybody, for attending this webinar, and see you soon. Thank you, and bye-bye.